Welcome to the Chambers Tech Summit. I'm Claire Roxborough, the Content Management Director at Chambers. Today's session will be recorded and available to view on demand after the event. There's so much to discuss in the tech space, and today's session will no doubt be packed with discourse and information. It is our pleasure to host a series of panels featuring experts in the field of tech M&A, blockchain, and cybersecurity. With each panel led by contributing editors of global practice guides, we aim to bring you robust conversations on the most topical issues and developments. The event also includes analysis from Global Research Director Simon Christian and Research Manager Matthew Court. We intend for this to be an interactive event and encourage the audience to submit questions during each session, which the panel will answer at the end. And with that, I'm pleased to hand over to George Casey, contributing editor of our Tech M&A Global Practice Guide. He will be moderating the first panel on tech market trends and expectations for 2023. George is joined by Harold Salsner at Noerr, Ilya Trakchuk at Integrites, and Don So at Kim and Chang, all experts from the Global Practice Guides. I would like to encourage participation in the audience poll during the session. So with that, I'll hand over to George.
Thank you very much, Claire. Good morning, good afternoon, good evening, everyone. Thank you for joining us. And also thank you very much to all the contributors, both those who are on this panel today, but also many others who contributed to the Chambers Technology M&A Guide, which is in its second year now and available online on chambers.com. What we will discuss during the first session of today's conference, this particular panel will focus on trends in technology M&A. And so we'll cover a number of things. We'll look at some trends in the US. We'll talk about Europe, where Harold will be talking about Germany and EU more in a more broader sense. Don will be talking about trends that he's seeing in Asia. And Ilya will be talking about trends in Ukraine, which is, needless to say, one of the most challenged markets and most challenged situations in the world today geopolitically. So to put things maybe in perspective a little bit to start this conversation, we saw 2020, 2021 as a boom market in technology M&A, probably one of the hottest markets in technology M&A ever seen. When the pandemic started, we all were thinking what's going to happen. And of course, technology industry as a whole benefited from a pandemic because people switched to using technology. We all started using video much more than we ever did before. That prompted purchasing of hardware by companies that, as people started working remotely, that boosted earnings for tech companies that are in hardware part of technology industry, prompted advertising and so on and so forth. We saw some of the groundbreaking IPOs, sky-high valuations, specs, de-specs, M&A was booming. So the incredible run in 2020, 2021. But what a difference a year makes, right? 2022 was a very different market in many respects. So the industry was facing headwinds, and not only the technology industries, general economy has been facing headwinds. There were fears of inflation. Central banks were acting on it, increasing interest rates. There was overextension of commitments by banks. So there was reduced availability of financing that led to major volatility in securities markets. And so we saw that there was a definite cut in purchasing of hardware by major buyers. There was cut in advertising. Technology industry got hit very, very hard. We've seen reduced earnings for technology industry. I'll give you some numbers. Out of 91, that's according to Financial Times that published a report just recently, out of 91 recently listed public companies, only 17 were profitable in 2022. And these companies burned through 12 billion in cash that they raised in IPOs. Because of drop in earnings, because of volatility, valuations came down for high growth companies that went public in 2022, 2020 and 2021, their valuation came down by about 70%. Blockchain crypto contributed to it. So M&A market overall was down by 40%, but technology actually was a little bit better than that. But what does it all mean for technology M&A? By the way, we will be posting poll questions to get your sentiment as to where technology M&A you think may be going, and there will be some other interesting poll questions. But what does it mean? Those are the type of things we will be exploring. Companies that were able to raise cash and burning through it and cannot still get to profitability, they need to consider what to do, right? IPOs markets were shut down, de-SPACs are not available, valuations are down. My prediction, and that's what we will talk, that probably M&A will be strong in 2023, not necessarily for good reasons, likely as a defensive move by many of these companies. But I'll open it to the panel, and let's go around the world and see what people are seeing and doing in different parts of the world. Harold, maybe starting with you, Germany, Europe, what do you see? What do you think the current trends are?
Yeah, many thanks, George. As you already indicated, we are in the middle of extraordinary times, still dealing with the aftermath of the pandemic. We see geopolitical conflicts, in particular the war in the Ukraine, supply chain challenges, increasing level of inflation, concerns of a recession since the third quarter of 22, just to name a few. In Europe, actually, the market cooled in line with what you just described in 22 after a record-breaking period of a number of years. When talking to bankers and to clients, it is expected that activity will normalize at a lower level in 23. And the third quarter, 22, we really saw a true cliff with roughly 8,300 deals year to date, totaling around 845 billion euros, resulting in a drop of 14% year on year in terms of deal volume and 16% decline in deal value. So that was quite a shock. But even in this overall challenging market in Europe, M&A activity and the TMT sector in 22 showed a continual high market activity compared to 21 and also compared to other industry sectors. UK and Germany were the most active markets in Europe, and actually the same is expected for the year 23. Technologies is expected to lead the bunch in M&A deal making, with financial sponsors, for example, trying and eager to get hold of tower assets. That already started in last year with, for our standards, the biggest transaction was the Brookfield acquisition of the 51% stake of Deutsche Telekom's tower asset. We would expect that those kind of transactions will increase because independent tower cos, as they are called, are in Europe relatively small, 35% compared to a rate of 95%, for example, in the US. And so that there was much more deals expected in that area in order to realize capital efficiency attached to sharing this infrastructure. Fundamentally, there are several factors relevant for the prospects of tech M&A in Germany and Europe. Obviously, there is a growing environment for thriving tech businesses and innovation of new technology-based business models. We like to refer to our little success stories beyond tech. Obviously, the vaccine, which is distributed under the name of Pfizer, but we are very proud that it's a German little Mainz-based company. SoundCloud, Zalando, HelloFresh, Flixbus, just to name a few. Maybe even more important for tech M&A are the effects of digital transformation requirements of established businesses. The accelerated technological change and emerge of new digital business models is a challenge for companies. They need to adapt in order to meet customer requirements. and the fast pace of digital trends is really requiring external digital expertise. Those companies need the technology, the know-how, and also the people, actually. That is pretty much true. And there are many attractive targets available. So we would expect that there will be in the EU and in Germany a real number of activity in that sector. Yeah. And finally, just one consideration: technology will also play a key part in respect of achieving ESG targets and to be ESG compliance. So that would also be something we would expect will flow into the M&A market.
Thank you, Harold. Very, very interesting. Maybe switching to Asia. Don, Asia obviously is a vast region, right? So we'll need a number of days actually to discuss all the trends in Asia. But taking it at a very high level, what you are seeing in Asia.
Yeah, so I think what we're saying in Asia is very similar to global trends, where you had record-breaking M&A activity, especially in the tech sector in 2020, 2021. And then even through the first half of 2022, there was robust activity, and then sort of a cliff from the second half of 2022, kind of continuing to today. And I can speak about my jurisdiction, South Korea, first. Again, I think the total M&A deal volume for 2022 was about $65 billion, which was about a 40% drop from the prior year. So
consistent with global, yeah.
Correct. So all these same factors, all the headwinds such as interest rate hikes, geopolitical tensions, and inflation, and so forth, all of that have had an effect on M&A activity, as well as the strengthening dollar for outbound activity for Korean companies. Now, because 2021 and 2022 first half were so robust for a lot of tech companies, a lot of them were planning for IPOs, and a lot of them through the second half of 2022 have been put on hold or dropped entirely. So it's caused a lot of concern and restrictions on founders and investors to exit their investments that they've been holding for quite some time. Now, having said that, I think there will be sort of other ways, and I would think that M&A activity will be another way for exits to happen. But overall, the tech landscape in South Korea is very robust. In all of Asia, it has really emerged as one of the hubs of innovation and development. There's a lot of R&D happening, and in fact, and there's more of a stratification of the market participants in the tech space. Traditionally, it was dominated by major conglomerates like Samsung and so forth, LG. But now you are seeing a lot more mid-tier tech firms, as well as a lot of startups and VC activity. And while I think the prevailing view is that we have certain current headwinds, but that eventually it's a matter of when, right? Not if. And so there's a lot of capital that's in store for investments. So I think all of those will come to play. And I think the major thing will be really inflation and interest rates. And not so much the fact that there will be hikes. It's really people are looking for some sort of stability and predictability.
Stability. Yeah.
Right.
Yeah.
So I think that's what is weighing on minds of investors as well as founders, et cetera. But again, you have all the various sectors and industries, from AI, autonomous driving, to electric vehicles, cybersecurity, device manufacturing, software. All of those areas are very active, both domestically and in terms of outbound. And we are seeing a lot of interest from foreign investors looking at Korean technology companies and so forth. Japan is sort of its own world. They have not been so influenced by interest rate hikes. And I think the tech scene there I think is fairly active, and really, I think most of the Japanese companies that we interface with are looking for outbound investment opportunities. And then China, again, I will kind of skip on China because it is a very vast sort of market. But Southeast Asia, I think, is a really interesting area because places like Singapore are obviously very developed in their tech infrastructure, as well as their tech investments, companies, et cetera. Internet penetration is extremely high. But you look at other jurisdictions like Vietnam or Indonesia, Malaysia, and sheer population-wise, it's a really promising area. And you are seeing, interestingly, a lot of tech M&A or investment opportunities, first of all, in the financial sector, as well as in sort of the more consumer type areas such as ride hailing and food delivery, et cetera. And I think it's really, within Asia, it is a very attractive investment destination. And we certainly expect to see those jurisdictions to garner a lot of interest in the next coming 5-10 years.
Thank you, Don. Very, very interesting. Ilya, turning to you. First of all, obviously Ukraine is in the middle of this horrendous war, and so needless to say, not just the economy is disrupted, everything is disrupted in Ukraine, and people are suffering beyond anything that anybody could have imagined. But talking about technology, what many people did not realize, and probably learning more about Ukraine now during the war, that the tech industry in Ukraine is one of the strongest in the world, actually, a destination for capital, tech companies, Ukrainian startups going abroad, listing on major exchanges. M&A activity involving tech companies in Ukraine has been quite significant. Notwithstanding the disruption and the horrendous situation currently in Ukraine, can you talk about IT industry in Ukraine, what you are seeing in the current trends, maybe before the invasion, now during the invasion? What are you seeing? Ukraine is often referred to as brains and grains, right? And brains go to actually, in many respects, to the highly educated and sophisticated people, particularly in the computer science and IT. So to you, Ilya, and thank you for joining us. I know this is not convenient even to find the proper Wi-Fi spot in Ukraine these days. So I'm so glad that you could join us.
Yeah, thank you, George. Indeed, a number of big names in tech industry have Ukrainian roots. And before the war, I would say that Ukrainian tech market was merely the same as European or American market, showing quite good boost in terms of the development. And even though we still have the war, the results of 2022 shows that IT sector is still in growth, even despite all the interruptions we had. And this became possible thanks to large players on the market, which had sufficient financing to survive the hard times and to use their potential to continue the growth. It may sound a little bit strange, but the war boosted the development of certain IT projects like the one in the military area. Indeed, many specialists channeled their efforts to develop defense projects. I give you an example of a startup that, for example, before the war developed the drone management software system for peaceful purposes like field aeration or delivery of goods. And after the war, they switched to more military purposes. And the same did a number of other IT companies that managed to adapt their technology to the current needs of the country. Here we can say about the reporting of damaged cars, delivery of humanitarian aid and medicine, delivery of food, informing civil defense alarms, and many other directions where we see the development of IT technology currently in Ukraine. In terms of the M&A, of course, 2022 was a total drop in Ukraine. We have had Very few transactions involving technology companies, mostly structured outside of Ukraine for obvious reasons. However, since most of technology companies have resumed their activity and showed certain growth in 2022, we stay optimistic in terms of the recovery of M&A market.
Thank you, Ilya. And I would add that you're just talking to Ukrainian friends, it sounds like digitization in Ukraine is actually at the forefront. Many other countries, what I've heard, are actually trying to emulate, looking at how Ukraine digitized economic, social, personal life for people. DIA that people are using on their phone, the software that pretty much has everything, right? It's almost futuristic in many respects. Some Ukrainians are telling me that when they're coming to Europe or the US, they feel like they're backwards because they do not have access to the same technology that they have in the country. So fascinating. Thank you, Ilya. Maybe then switching a little bit our topic to, in the current environment where financing is challenged, right? It's very difficult for young companies to raise funds because equities markets are challenged, financing through banks challenged, no de-SPACs. So looking at where funds may be coming from, and maybe talking about how in different parts of the world startups get support. Dan, maybe starting with you, South Korea has had a long tradition of supporting young startups. And there were initiatives and actually a fund launched by the government, right, to promote and support startups. Can you talk a little bit about, how this is handled in South Korea?
Sure.
Are there opportunities for foreign investors as well, but mostly, these funding opportunities for young technology companies?
Sure. So the public-private partnership in funding startups and early stage businesses is very well established, as you mentioned, George. And it's a great area of interest. And, there are certain political reasons for this because with, the younger generation, a lot of them either don't feel as though it's desirable to join, for example, the traditional large conglomerates, and they want to try something on their own, or just in the public imagination, the thought of having a very successful startup is very strong. So the government has provided, as you say, a fund. It generally is an LP that invests in a fund of funds, and it will also have matching programs for other investors to come in. But really, it's to provide those funds for startups. And there's no real preference for a particular industry, but it is still heavily geared towards sort of the tech and sort of the bio space, healthcare. Now, the government also provides a lot of resources in terms of providing, networking opportunities, linking startups to experts, providing them access to foreign resources as well. Also, really encouraging incubators, accelerators, and so forth. So if you are a startup, I think all startups will have difficulties, but in terms of procuring funding, even in this current environment, I think it's compared to other jurisdictions very favorable. And financing, the government also is thinking of providing very low interest rate loans, basically, to startups, and also providing a lot of tax incentives. So lower tax rates being in certain tax benefit zones, or if you are a seller, if you sell and reinvest in another startup, there are tax benefits. But in an environment where profits are challenged, it's questionable how much the tax incentives will really be of help. But the general tenor is that the government, especially the Ministry of Small, Medium Enterprises and Startups, they are very active and very supportive.
Very interesting. Thank you, Dom. Ilya, talking about Ukraine, I understand Ukraine also has similar initiatives sponsored by the government to support the technology industry. Can you talk a little bit about this and also talk about opportunities for foreign investors. Obviously challenging to do it during the war, but there is a lot of interest. Talking to investors I know in tech industry, there's a lot of interest actually in investing in tech startups, young technology companies, even more mature technology companies in Ukraine. I've been asked to speak to Ukrainian business community how to position Ukraine for foreign investments. Can you talk a little bit about the combination of government support, development, and foreign investment opportunities?
Yeah, sure. Well, actually, for the last 3-5 years, Ukraine has made a number of significant legislative improvements aimed at development of local IT business, as well as attracting foreign investors. One of such novelties is the creation of so-called DSCD, which is kind of legal and tax regime for IT companies and startups. Actually, it was launched in February 2022, so 2 weeks right before the war. And the idea was to use the best practices taken from different jurisdictions like Delaware and Singapore for simplification of the procedure for creation and management of the business, of IT business, IT companies. Also, this regime gives an exceptional tax preferences for the residents of DSCD, which stimulates further development of the business. Finally, this special regime introduced well-known English law instruments which have not been common for Ukraine before. I'm talking actually about very common things like convertible loans, representation warranties, liquidation preferences, and other instruments. All these efforts are made with the sole purpose to create favorable environment for the development of technology, business, and this is actually only the beginning. We are continue working on the creation of standards for M&A documentation, for investment documentation in terms of the support of IT startups, additional instruments for structuring of the financing. This is all in process, but the first and the major step is already done in terms of the government. Of course, the war changed the situation, and now the startup level is the most vulnerable one. So the state adopted the program for the support of IT startups in Ukraine and allocated a significant amount for support of the startups. The same was done actually by EU, which launched a 20 million program to support IT community in Ukraine. And we see that this trend was also supported by international giants like Google, who created their own funds to support Ukrainian IT startups.
Thank you, Ilya. Harold, you talked about innovation a little bit. Germany has one of the most mature technology industries in the world. Can you talk a little bit more about innovation and how innovation is funded and supported in Germany, current trends that you are seeing, opportunities for foreign investments and so forth?
Sure, George. Obviously, for Germany, transformation by way of technological innovation is key. We are really not famous for commodities anymore, and our workforce is much too expensive compared to other places in the world. Hence, we need to be innovative to be successful. And just look at the automotive industry, which is the backbone of the German economy for decades. Yeah, the challenges we are facing and the transformation of this industry, particularly with respect to electric vehicles, autonomous driving, you name it. Yeah. So innovation is needed a lot everywhere, ranging from the DAX 40 issuers to the famous German Mittelstand, and some of the issues are really how to get innovation, but maybe even more important, how to retain innovation. Obviously, there are two different tracks to go. One is being innovative and building new business models in-house or acquiring it by external expertise. We have in Germany a busy and active investor scene in Germany, providing venture capital, including specific venture capital funds, corporate venture capital funds. They are super active because they know that this is their way to get access to innovation, as well as government-sponsored funds, pretty much the same as mentioned by Don. I think the German government knows that we need to be super active there. But also, to be fair, and that's also something Don already indicated, it looks like that young talent is more fascinated by going startup rather than the idea of joining big companies, with all the monitoring and controlling rules and procedures and so forth. So that typically a lot of innovation first goes into the startups, not really into the R&D divisions of big companies. When it then comes at a certain point in time to getting hold of that innovation by, for example, tech M&A, so the big corporates are trying to acquire those young talents and the know-how, the technology, and so forth. That's not coming without significant challenges. Obviously, the cooler the technology is, that will have an impact on pricing, so it's not really cheap. The second thing is really an issue of post-merger integration, and we have seen that a lot, that companies have tried to acquire for a lot of money technologies, the know-how, and actually the people representing that know-how. And then there was a certain cultural clash afterwards. And so clients really should think about that in advance in order not to mess up the whole transaction idea. So when trying to integrate those innovative digital natives into big corporates, if the level of integration is too high, there may be an impact on the retention of those people, and thereby the level of innovation moving forward. If, on the other hand, the level of integration is too low, and we have seen both kind of strategies, if it's too low, then the innovation may be okay, because those guys can, within a bigger group, do their own thing as before, and they are happy. But the benefits of the innovation, because of the low level of integration to the overall institution, may be limited. And also you may face issues that other groups, employees, stakeholders within the company may become very unhappy that about the special treatment of those acqui-hires. So that's a true challenge. So it's expensive on the front end, and there will be significant issues post-merger integration in order to keep it and to make it a true success.
Yeah, it's very, very interesting, Carl, right? Integration is key to M&A deal, right? Often M&A practitioners think about the deal itself, right? But it's really the integration that ultimately either makes the value justified, what you pay for the business you're acquiring, or not. And it's how do you strike that balance between, for technology companies in particular, between making sure that you integrate the business you are buying, but at the same time not undermining the innovative nature of the young company, young technology company that you are buying, and not driving people out. So how you strike that balance is probably one of the key issues in M&A deals. Let's talk a little bit about some specific deals we're seeing in the markets now. Maybe touching a little bit more on what I mentioned at the outset of our conversation. In the US, what we're seeing is that there are several aspects that I believe will be driving M&A markets in 2023 and the type of deals we're seeing in the markets. One, it's the fact that valuations came down, right? Valuations came down. Some of it because they were too high, some of it because earnings actually significantly came down, some of it volatility in the markets, but one way or the other, valuations are down, as I mentioned, for high growth companies by 70% actually. So which means it creates really a buyer's market, so long as the seller is willing to transact at those levels of value. And so buyers have opportunities, but buyers are concerned at the same time in the current market environment, in the current economic environment with major disruptions, to pull the trigger and actually do the deal. But there will be opportunities. And so if people can agree on valuation, that's going to be driving it. On the young company side, some of the drivers that I'm seeing are the fact that companies, those that raised cash, are burning through cash. As I mentioned, $12 billion were used by companies that raised that money in the IPOs during 2020, 2021. And so running out of cash without easy access to either debt financing or equity financing may push companies actually to consider an M&A transaction or consider taking significant private money into the company. The other thing that we are seeing is that those companies that went public or have been public for a while, they are considering, going private. So that you take the company off the radar screen and the focus that public companies face. So going private transactions, significant private investments into companies, those are the type of trends we're seeing. And traditional M&A. Also stock for stock deals, probably we will see more of them in 2023, because needless to say, for M&A practitioners, right, you can do stock for stock deal at high valuation so long as both companies at that level, or at low valuation if the market is down, so long as you overcome volatility. So those are some of the things, some of the types of deals we're seeing in the US market. So Harold, maybe staying with you in Germany, what are the types of deals you are seeing these days in the German market? VC financings, IPOs, de-SPACs, spin-offs? What are the most typical deals you're seeing in the market?
Actually, we already touched upon, we have a robust venture capital industry, which is obviously important for our scenario here, innovation, digital business, and so forth. That is backed up by early stage financing, government sponsored programs, business angels, early stage investors, family offices, all a bunch that in that sphere. On the listings, on the IPOs, obviously that's in general a very nice way of arranging for an exit. And we all know that already in general times there are the peaks and the downs, in view of the well-known IPO risk, volatile markets, level of appetite of investors, the listing rules, and so forth. Now, it looks really bad. When talking to ECM bankers, they hope for a couple of mega IPOs in order to make good for the year, because they do not believe that there is no confidence in a significant number of mid-cap listings. We saw in the tech side earlier this year, Janos, that is a subsidiary of United Internet, a leading web host, specialist in cloud solutions and so forth. Already very disappointing opening price, 1845, and it dropped. And I think yesterday I checked it, it was something like below 16 or so. So that is a more pessimistic or disappointing view on the IPO market. Yeah, typically now investors are even more critical on how issuers plan to protect margins. That's pretty clear. And the better the quality of the business is, the more flexibility the owners have to fine-tune timing and not to run into something just because of the cash needs, George, you just described. Typical other IPO candidates which are discussed in Germany include Schott Pharma, Stepstone, this classified arm of Axel Springer, Ukera, that is ThyssenKrupp hydrogen plant manufacturer. Coming to SPACs, we also had a little SPAC wave, not like compared to the US, but this is totally done. There are no de-SPACs anymore, and more investors are going to withdraw their capital. So I think that's for now.
Same in the US. Yeah, same in the US.
Spin-offs and auction sales obviously have been a very dominant transaction route in Germany and in the European market, and that will continue to be the case. I think it will be more problematic to have these kind of bread and butter auction proceedings that will probably be more of a problem. Financing, also that has been addressed earlier, has become obviously more of a challenge. So in that respect, we will also see more bilateral transactions compared to other periods. Financing deals will become more problematic for the largest deals to the extent they rely on liquid debt capital markets. Smaller deals obviously are less affected because there are well-capitalized direct lending funds around willing to deploy senior loans for buyouts. But really the big ticket thing, that will be more of a challenge to put together the respective financing. On the corporate side, money in general is available. It's more an issue of valuations, and as you said, they are coming down. The issue is whether they come sufficiently down in order to make it attractive. A lot of people say that M&A deal makers will be much more focused on few targets, but those targets will then be pursued even more vigorously. I think generally, given the overall cornerstones of the requirements for the technology transformation in many industries, there is really no chance for deal makers to come to a break. They need to make sure that they're not missing the train here and identify the relevant targets, obviously also for the relevant prices. So overall, cash-rich corporates will get their opportunities as well as well-funded PE funds. Multiples are expected or are going down, but nevertheless, people need to be very careful and diligent in finding the right targets, and then I think that will also translate in a number of opportunities.
Thank you, Harald. Dan, how about South Korea? So what type of deals are you seeing most these days? Is it outbound licensing? What are the most? What are the deals that you're seeing the most in the market?
Yeah, so I think this period of time, and also in speaking with my colleagues, is really sort of unprecedented in the types and complexity of deals. So there's really, because your liquidity exit through an IPO is limited, and financing is not so available, they're really trying to come up with creative solutions for those who are looking for an exit to accommodate that. And for example, for public companies, I think sort of pipes deals are being looked at a little bit more, as well as in the private context, similar arrangements with convertible instruments, where the buyer really can get a good deal. But still, as you mentioned, George, there is a valuation gap between sellers and buyers. So I think trying to overcome that is really difficult. But for some companies, a lot of it is sort of restructuring oriented. So there's a lot of divestitures through a normal M&A process. And in the sort of early stage or mid stage companies in which, and I forgot to mention this, the corporate venture capital environment is very robust here because a lot of the conglomerates, they want to try and diversify. And especially because these corporate conglomerates, now you're coming down to the third generation of the families, and they are a little bit younger. They want to try different things. So you see them doubling down on some of their investments into startups. So you see those types of transactions quite a bit. A lot of outbound activity, I think, for larger companies in the tech space. They view the Korean market as being too small or saturated, and they really are looking to build outside, especially in places like the US that may have tangential technologies to electric vehicles, such as batteries. So a lot of greenfield type investments in the US. But that has also been kind of put on hold and because of the currency headwinds. But the Inflation Reduction Act is very attractive to a lot of Korean companies to build out sort of tech-related assets. And in terms of foreign funds and foreign investors, there is a lot of interest, but they are very strategic. So they're looking for particular technologies, and in those cases, certainly licensing, and also in the CVC cases, they are very, very interested in receiving a license to any technology developed by their invested companies, especially in biopharma. So I think you are seeing that. But at this point, it really runs the gamut and people are being very, very creative to seek opportunities to invest as well as to exit.
Thank you, Dan. Ilya, how about Ukraine? So what type of deals are you seeing now, and what you've seen before the war? Is it more investments into the country, into tech companies there, tech companies venturing abroad and doing an IPO outside of Ukraine, or an M&A deal outside of Ukraine? What are the trends you are seeing?
Well, I would say both, depending on where the company is at its development, because actually the financial market in Ukraine is not that well developed, and thus the access to the financial resources is rather limited by the local players. So for those companies which are relatively big and may allow themselves to have the international structure, they of course would try to also seek for the international financing using all the instruments of European or US markets to get it either through IPOs or other means. For those which are at early stage of financing, which don't have the international structure, they're basically tied and limited with those local aggregators or local remedies which are available. And of course, we have international foreign venture capital funds which are on a permanent basis looking for the good targets in Ukraine. We have Ukrainian venture capital funds which are again looking to pick up the best IT companies. But again, in terms of the technology companies in this case, they are more bound by the proposal they receive from venture capitals than the situation where they are able to dictate the rules. The same refers actually to the exit rules, because those who already constructed the compound international structure, they would prefer to exit outside, and those who are in Ukraine, there is no other choice as to do that. And in terms of reward trends, we see that even those IT technological companies which were present purely in Ukraine, they are trying to build up the international corporate structure abroad Ukraine just to diversify the risks. And when they did that would mean that in case of the exit or seeking for the financing, they would use it, which is absolutely normal and logical in this situation.
Thank you, Ilya. We have just a couple of minutes left for this particular panel discussion. So if I may ask you guys, taking the crystal ball and kind of looking in the crystal ball and trying to predict what type of M&A activity you will see in 2023. And we have a poll actually for everybody who is participating in the conference to get their views, but for the panel, and I'll venture first, as I mentioned, I believe that M&A market in technology will pick up in 2023 and going to be strong, sometimes for good reasons, sometimes for defensive reasons, because companies will need cash. So, but I expect that the market will pick up, particularly in the second half of 2023, but maybe even earlier. So, Harold, your view on Germany and Europe more generally?
It's very
crystal ball.
It's very difficult, George, just to not agree with your assessment and outlook. Maybe we have the same crystal ball in our trunk. I think, that's right. I think tech M&A will be an important driver for M&A activities overall. And that is because the world is changing and technology is the center part of it. Number two, I think, is volume of deals will largely depend on availability of funds and financing. That is the general theme. And what I also, when I look deeply into the crystal ball, I would also think about, interesting to see how ESG will be a driver for technology in order to make them achieve their trends. I think that's something I would like to think about a little longer, and because that will come to a very important stage.
Thank you, Harold. Dan, in Asia?
Yeah, I think I share George, your view as well as Harold's view. Like I mentioned before, it's not a matter of if, it's really a matter of when. I think everybody in the M&A market really they see tech M&A as the area to be in. And I think that's true for most of Asia. And so this really will be the bright spot. And you'll continue to see the industrials and chemicals M&A space being active, but really I think we are on a path of a digital economy with innovation being really at the backbone. And for a country like Korea, where it produces content as well as technology, and it will really heavily focus on technology, tech M&A will be the theme going forward, and I suspect it's going to be the same for most of the Asian economies.
Thank you, Dan. Ilya, and your crystal ball probably the most challenging. I'm confident that Ukraine will win this war. What's your view in 2023? What likely gonna be the environment for investments? By the way, our hearts and minds are with Ukraine, and we're standing strong with Ukraine throughout this period of war. But can you talk a little bit about what you expect in 2023?
Yeah, thank you, George. I really hope that I will be able to share the optimism of Harold and Don in terms of the development of technology market, because Ukraine has a great potential. We have incredible examples of Ukrainian technology companies being developed into international one, showing the perfect results. I see that we have a lot of potential for new companies to do the same. Technological market was not hurt by the war compared to other markets, so I believe that it will show better recovery than other sectors. So I'm keep positive in terms of the perspective of M&A transactions in Ukraine, of course, as a part of Europe.
Thank you, Ilya. Thank you. And again, we are standing with the people of Ukraine. We're confident that this horrendous war will end with the victory. Thank you for joining. Yeah, I know how challenging it's been for you to join. And this wraps up our conversation. Thank you very much, Harold, Don, Ilya. Hopefully everybody enjoyed our conversation. I certainly enjoyed this conversation with the rest of the panelists. And again, thank you very much to everybody who contributed to the guide. There were a lot of contributors who we could not have with us on this panel today, but we'll try to do it in the future. And hopefully everybody who has seen the guide enjoys the in-depth discussions of technology, M&A trends, how funds are raised, how deals get done in the Chambers guide. So thank you all. Claire, back to you.
Thank you, George. Many thanks, George, Harold, Ilya, and Don. It was a fantastic discussion. I can see that Greg, Chu, Melissa, and Ben are here for our next panel on blockchain. I'll hand over to Greg now.
Hi, thank you very much, Claire, and very excited to be here today with a great panel. We're going to be talking about developments with respect to blockchain technology and sort of talking about some recent events and using this opportunity to sort of contrast centralized versus decentralized systems utilizing blockchain technology. My name is Greg Strong. I'm going to be moderating the panel. I'm a partner at DLX Law, which is a boutique law firm in the United States with offices in New York, Wilmington, Delaware, and Washington, D.C. And I'd like to hand it over to our panelists to introduce themselves. And Melissa, maybe we can start with you.
Thank you, Greg, and thank you, Chambers. So I am Melissa Lim, and I am a partner at Walkers, and I co-head the global fintech group at Walkers. Walkers is the largest offshore firm in the world, and we practice Cayman, BVI, Bermuda, Guernsey, Jersey, and Irish laws.
Thanks very much, Melissa. And Chu, can I turn it over to you?
Sure. Thanks, Greg, and thanks everyone for inviting us. My name is Julian Chua. I'm a director and the head of the blockchain and digital assets practice at Napier. Drew Napier is one of Singapore's largest law firms, and we're a full service practice covering all aspects, and particularly with respect to in the blockchain cryptocurrency space. We handle both regulatory and dispute matters in the space.
Thanks very much. And Ben, bring us home here.
Sure. Thanks, Greg. Nice to be here. Ben Bathgate. I'm in Toronto, Canada. McMillan, one of Canada's national law firms, and I co-chair our fraud group and work extensively in tracing with digital assets and crypto and looking at court remedies that applies largely to that space.
All right. Well, very relevant experience for the call today, and I wanted to just take a minute before we dive into things to sort of set the stage. Over the last 6 months to a year, we've seen a lot of activity in the blockchain space, and in particular, we've seen some failures in centralized business models with a wave of bankruptcies that really was sort of predicated by the collapse of the Terra network and the Terra USD token and the Luna token. And so what followed was an insolvency of Three Arrows Capital, which was a very large hedge fund, which had some activities in Singapore, but was based outside of Singapore and in the BVI. And then some related bankruptcies with respect to Celsius here in the US, Voyager also in the US with a Canadian twist to it, FTX, BlockFi, and most recently Genesis. And so I guess sort of stepping back and looking at this generally, you know, what happened here? And maybe, Drew, if you could start us off with some thoughts generally about how we wound up in this spot.
Sure, and I think we're continuing to find out more about the web of transactions that led us to the entire wave of failures. As each liquidation proceeds and more information comes out, I think we're getting a deeper and deeper picture. I wouldn't say wider, just because it turns out that it's getting more and more complex as we see it. but the first visible event, I think, was the as Greg, as you mentioned, the collapse of the prices of the Terra Luna network, and that triggered a margin calls on Three Arrows, which, as you mentioned, was a very large hedge fund. And Three Arrows, as a very large hedge fund, had deals and was a counterparty to a multitude of other players in the crypto space. So we're discovering that with many of the large players, they have very significant interplayer deals going on with where the exposure of one triggers consequential impacts on another. So I think where we are is where we are right now. And I think we all do expect that we'll continue to be further collapses.
Yeah, thank you very much. And Ben, you mentioned that your practice is on the fraud side with respect to asset tracing and related issues. Do you have any thoughts about sort of the interconnectedness of these entities and how you would go about untangling sort of the transactions at issue here?
Yeah, I mean, it's a big question. I think with FTX specifically, and we've talked before about some of the multi-jurisdictional issues that have come up. There is certainly a bit of a black box that exists there, and that's just something we've all had to come to terms with in this market. And I think it's been interesting as we've looked at that process with FTX and seeing the insider trading, if you can even call it that, that goes on. We do start thinking more about the risks that are involved in those areas. And as we get into, we're going to get into decentralized products more later, but as we get into those kind of areas, you see a lot of compounding of the risks as well. You see collateral that's crypto, and you see all these other issues that crop up, trading upon trading and loaning after trading. There's a lot of intermingling and use and reuse of a lot of these underlying assets. And I think we'll talk more about it, I think, in the next subtopic, but I think we see a lot of compounding of those risks and not a great lens into what's behind it all.
Yeah, thank you. Melissa, I don't know if you have anything to add on these points.
Yes, so I think that was a big high profile article on how Cayman was very much affected by the FTX collapse, with many Cayman creditors. I suspect that those are really the Cayman crypto funds, because Cayman has been the #1 jurisdiction for crypto funds by far, actually, based on a recent PwC report on crypto funds. And I suspect that given that the collapse of FTX only occurred in November, there probably wasn't sufficient time for any redemption notices to be submitted in time, or redemption requests to be submitted in time for December 31st. So it will be interesting to see what effect it will have on the Cayman crypto funds for the March 31st redemption date.
Yes, that will be very interesting. And so sort of jumping ahead to talk more about FTX, obviously there are a whole litany of different proceedings involving FTX. At this point, there's a bankruptcy proceeding here in Delaware, where I'm located. There is a criminal case with respect to individuals who were running FTX, or multiple criminal cases. And then there are SEC and CFTC enforcement actions in the US. Ben, I wanted to just ask you, when you have a number of different matters going on like that, does that sort of put you in a different bucket than just typically what you would see in a fraud litigation that's civil in nature only?
Yeah, I mean, it's the fight before the fight, right? And I think that's really interesting. And we saw it in the early days with FTX to the bankruptcy proceeding. I'm not a bankruptcy lawyer, but obviously working in the crypto space with tracing and fraud, I see a lot of it. And it was interesting with the FTX case, how you saw right from the get-go, the things we take for granted, like a stay under, Chapter 15, even those kind of things not being something you could take for granted. I mean, it was interesting to see there how right away the Bahamian regulators, try to fight to retain some control through the liquidation process. They backed off at a certain point. The Southern District in New York obviously got involved. But you're seeing arguments right from the get-go about what was going on in the Bahamas. The rumors about Bahamian authorities encouraging Bankman-Fried and some associates to give their customers preferred treatment. I mean, what was going on there? You see a certain kind of expectation what's going to happen when you've got a Chapter 11 process in the U.S., but then you've got early days, things already starting to move and people getting certain preference allegedly. So I think, there's the fight before the fight. And I think that's an interesting one because, right away, everybody's running out to get out of the sinking ship, so to speak. And some of the things we take for granted in terms of stays and processes like that it's going to go through a regular process. You can't even take that for granted anymore.
Yeah. Very interesting. And I noted that there was a recent lawsuit filed on behalf of FTX, or Alameda Research, actually, against Grayscale related to GBTC. So obviously, significant efforts being expended to try and recoup assets back into the bankruptcy estate for the benefit of creditors. And it'll be interesting to see how that lawsuit plays out from a number of different perspectives. Ju, I wanted to ask you, Melissa talked about the funds in Cayman and upcoming redemptions at the end of March. Three Arrows had some Singapore ties. Can you talk a little bit about what their activities were in Singapore and how they were regulated?
Sure. So to clarify, I think the Three Arrows fund itself, the fund entity itself, was at the BVI. The fund manager was in Singapore and licensed in Singapore. So the team, Suzu and Carl Davis, they lived in Singapore. Their office was here. Their families were here. Their homes here. And many of the investors were here. I mean, so one of the primary attractions for them to set up in Singapore is that it's a great place to access both Asian and Western investors. And the structure that they had, meaning a Singapore fund manager with the fund entity in the BVI, I think is very common among traditional fund structures. So in Singapore, they were licensed with the Monetary Authority of Singapore as a registered fund management company, and so this is the exact same license you would get as a securities fund. And so this license then allowed them to invest both in tokens as well as in the equity of companies and in securities and so forth. So that's where they were. They did get to a point where they received a reprimand from the MAS for vastly exceeding the assets under management that they were expected to have with that license. So that's one of the events that happened there.
Yeah, thank you very much. So I think we sort of mentioned the multi-jurisdictional issues in the context of FTX and a lot of these insolvencies. And, obviously, crypto assets are very easily transferable. And so this is a global phenomenon. Any thoughts from any of the panelists on any other considerations from a multi-jurisdictional perspective, given all that's gone on here?
I mean, if I can continue on the Three Arrows aspect, it was fairly straightforward in that case because the fund was in BVI, and so that made a BVI bankruptcy a very logical place. And the Singapore courts very early on acknowledged the proper jurisdiction of the BVI bankruptcy courts in that. Having said that, there are several court cases that have been brought up in Singapore, which have allegations against the fund management entity. And particularly, where things weren't certainly the allegations are that contracts were entered in the capacity of the Singapore entity and not of the fund entity. And of course, many of the team's personal assets are located in Singapore. So there's a completely parallel track to bankruptcy proceeding that's happening here as well.
Yeah, I would echo Drew, because a lot of the Cayman funds, the Cayman fund vehicle will be within Cayman, but the fund manager will be typically in the US. So definitely we deal with the multi-jurisdictional cross-border issues. Many times I've had our partners fly to the US and be the expert witness when it comes to Cayman law. So definitely we're very conscious of how important it is to ensure that we work closely with onshore lawyers, with the US lawyers on the setup of these structures and any dispute resolution of these structures.
I think as well, Greg. I mean, we talk about that sort of knock-on effect in different jurisdictions. I mean, Voyager lost a lot. It was on the Toronto Stock Exchange, and it defaulted on a loan of US $655 million. There was the whole issue coming from Three Arrows there. I mean, it lent $655 million to Three Arrows, a hedge fund that traded in crypto. There was the default then, and of course, no surprise when that took a hit with Three Arrows. Then Luna had its crash, and everything sort of had that knock-on effect. Then of course, Voyager stock plummeted, and then the investment industry regulators of Canada, IROC, come in and announce suspension of trading of Voyager. So that knock-on effect is so hard to avoid when there is this reliance and further reliance and compounding of these assets through these different platforms. And that's one of, I think, the key risk here, as we're seeing, as fraud is multiplied upon fraud, is just, how do you get a better lens in these compounding of losses when you do have this sort of shadow banking system in the decentralized finance world? And I know we're going to get more into that, but I think that's where a lot of that risk builds and builds and builds to points that we see in these giant schemes like FTX.
Yeah, thank you. And I think that raises, the next question, which is, in your jurisdictions, how are activities involving crypto assets regulated? On the fund side, Ju, I think you mentioned that Three Arrows was registered with the Monetary Authority of Singapore. Just give us a high level, sense of what the laws are in place that regulate this type of activity.
Okay, so for Singapore, I mean, we have the traditional securities laws that apply everywhere, and as I mentioned, Three Arrows is actually licensed under the securities laws as a securities fund. In addition to that, Singapore also has a specific regime for digital payment tokens. So it's a specific subclass of tokens that are used for payment. So this is under the Payment Services Act, and it's a licensing regime today for issuing of tokens and running a centralized exchange. There's also an amendment which has already been passed but is not yet in effect, which expands the scope of licensing to custody of tokens, centralized money transmission of tokens, and facilitating exchange without custody. So that's and so those all require a specific PS Act license, and those have been slowly coming out from the MAS.
Yeah, thank you very much. And Melissa, I believe the VASP law in Caymans is similar, right?
Exactly. So the Cayman introduced the Virtual Asset Services Providers Act in 2020, and in 2 phases actually. So phase 1 relates to registration, and phase 2 relates to licensing. So any Cayman entity that engages in a public sale of tokens, or the business of exchanging, transferring, or custodying virtual assets on behalf of others, or the provision of financial services in connection with the issuance or sale of virtual assets is required to be registered. Now, the phase 2 relates specifically to an upgrade of such registration into a license if you're dealing specifically in crypto custody or a crypto exchange or a public sale of tokens. That phase 2 is actually not in effect as yet. So right now we're just in a registration phase. And then similarly to Singapore, we have our Securities Investments Business Act as well. So if you're dealing in securities, if you're dealing in crypto derivatives, that's also considered a security, then we'll need to advise on whether that activity falls under that Securities Investments Business Act.
Great. And I think, in the US, just to speak on this quickly, we obviously have the securities laws, which, our current SEC chair would like to apply to most all digital assets. And so that is a facts and circumstances specific test to determine whether or not transactions involving those assets constitute investment contracts under the Howey test. But I think, it's definitely the view of the regulator here that that most offers and sales of digital assets would meet that test. And then I think, the other sort of guardrail is on the money transmission side of things. So registration as a money services business at the federal level, which requires Bank Secrecy Act compliance, and then registration or licensing at the state level in states in which you're going to be providing money transmission activities. And so most centralized exchanges in the US are registered as MSBs and have money transmission licenses in the states in which they're operating. But the next question really is, given all of the recent failures, what do we expect to see going forward from a regulatory perspective? Do you think there will be adjustments to these regimes or new laws passed in your jurisdictions? Chu, I guess I'll start with you. I know you mentioned that there's a custody component, and obviously, like a lot of the failed businesses here were custodying assets on behalf of customers who now cannot get them back or are standing in line with other creditors in a bankruptcy. So this is a significant focus, I think, from a U.S. perspective, and making sure that custodians of assets are clearly, setting forth the parameters and how, the arrangement is intended to work, because a typical custodian would be holding on behalf of the customer, not sort of like taking the assets onto their balance sheet and then going and doing other things with them. So I know from a U.S. perspective, custody is definitely in focus, and was wondering if the Payment Services Act is going to cover that, if it does already, or if it may in the future.
So I think for Singapore, I don't anticipate any changes in law from the events, and that's largely because the Singapore regulators were perhaps a little ahead of the curve on this. as I mentioned, the amendment to the Act to expand the scope of licensing, this was actually passed early 2021, long before this wave of contagion. So the focus on custody as the locus of regulation has been there. I think it's largely an enforcement question. I think as we've talked about, Three Arrows was already a licensed entity. Many of the exchanges that collapsed in their respective home jurisdictions were in fact licensed and regulated entities. So it's not a failure of the existence of regulation here, rather the difficulties of enforcement.
Yeah, understood. And to that point, I believe I saw an article within the last couple of days about an investigation of Terraform Labs. I don't know if you can comment on that at all, but it seems as though the Singapore authorities are pursuing something there.
I can't comment on it right now.
Gotcha. Well, I put you on the spot on that one, so apologies. Melissa, maybe we'll turn it over to you. You talked about phase 2 of the VASP law in Caymans. What will that address that isn't currently addressed in the phase 1 plan?
So the phase 2 is really the upgrade of the registration to a licensing for custody, crypto custody businesses. So crypto custodians are then required to comply with any requirements by the Cayman regulator on disclosures, on safekeeping of assets, processes and procedures, on segregation of assets, ensure that there are insurance in place, cybersecurity in place, whether there is any intention to leverage or hypothecate the assets in any way, which we know that that's become a big deal. But what is interesting is that currently there are no crypto custodians currently registered under the Cayman VASP Act. I suspect that in time that will be the case. And I think really in terms of changes to legislation, given the fact that we haven't had any Cayman entities that have been significantly affected by the collapses to date, the collapses tend to be in other jurisdictions. There is no, I suppose, pressure as such, and we don't really have, retail investors within Cayman who have been significantly affected as well, in general anyway. So Cayman continues to be very crypto friendly. The Cayman government continues to be very crypto friendly, and in fact, if there are going to be any changes in the legislation, it would be probably because of industry consultation, asking for more favorable changes rather than less favorable changes.
Great, yeah, thank you. Ben, let me turn it over to you. How do you see the custody issues impacting sort of the litigation and asset tracing activities that you're involved in?
Yeah, that's certainly the perspective I've got on is the loss holders and looking at the recovery perspective. I mean, we seem to be amazed time and time again, even with the biggest players, the lack of internal controls when it comes to the assets and how they're managed. And I think you put it well when you said before, Greg, it's not your keys, not your coins, right? The amount of control there is over that, whether it's a wallet or something more sophisticated than that. And there's even a classic case in Canada, which unfortunately put us in the limelight many years ago, of Quadriga, where it was nothing more than a Ponzi scheme, an old-fashioned fraud conducted through digital assets and a more sophisticated platform, but old-fashioned fraud. But $200 million goes missing. Mr. Cotton goes missing. And, his associates and family members kind of shrug and say, well, we don't have the key. What can we do? We can't help you, right? And leaving aside whether you believe any of that, it is a reminder, and a very expensive reminder, and we've had a few of these, as to the implications of that when you don't have insights into those internal controls that, we expect with many of our intermediaries and institutions. And when you've got some of these operations, which looks fairly sophisticated and large in certain respects, but have these types of very lax, simplistic internal controls, and ones that rely on a person or two people. I mean, it's outrageous considering the amounts of assets we're talking about that's what's done, but it is. So looking at it from that recovery perspective, that's one side of it, and the struggles that creates for loss holders. But also, if you don't run that problem there, I look at it from the side of the core process, because sometimes if there's disputes over crypto assets, then there's a question as to a core custodian and who's going to be named and ordered to hold those. And I can tell you from experience, not easy to find, especially with some of the exotic tokens out there. Not easy to find custodians that are going to stand up, ensure, protect those with Gnosis Vault or whatever they're using. Very interesting questions come up from that. I think we're still trying to figure out what the answers are.
Yeah, thank you. That's very interesting. And I think, just coming back to what we can expect from a regulatory perspective, in the US at least, I think there is an effort underway to sort of make sure that problems that may happen in the digital asset space are not somehow bleeding over into our traditional finance space. People may have been following what's going on with Silvergate and the troubles that they're having, given their relationships with a lot of customers that they had that are in the crypto space. And I think this is something that is definitely a focus in the US. And so I wanted to ask some questions about stablecoins. And Chu, maybe you can just describe for the audience, what a stablecoin is, so we can sort of set some groundwork.
Well, I think in its original iteration, the idea of a stablecoin was a token that was backed 1:1 with a fiat currency. So a US dollar coin, for instance, would be valued at and redeemable and backed by $1 at an account. And of course, that then leaves open the question, well, how do you know that the dollars are really there? As the space expanded, I think you also have what we call algorithmic stable coins. So coins that didn't actually have dollars backing them, but instead had a design whereby by the design of the algorithm was intended to ensure that the stable coin retained a value that was equal to the value of the fiat stable coin. So Terra, for instance, was an algorithmic stablecoin. I think those are much more complicated. Those I think you'll have to consider the algorithm backing that specifically, and to see whether that algorithm makes sense and whether that structure actually makes sense, as opposed to a backed stablecoin where your question really is one of execution rather than structure.
Yeah, thank you. That's super helpful. And the reason why I'm asking about stablecoins at this point is because I think really a stablecoin is sort of provides an on-ramp to sort of like the digital economy, and people who may be interested in acquiring other assets or engaging in transactions, that are sitting on top of blockchain, will likely have stablecoins as a primary asset that they hold. And so, as we see, sort of the clamps come down to separate the digital economy from the traditional economy, I guess the question will be, are stable coins going to be able to be used in that way going forward? And I think also there are some interesting, developments in terms of sovereign, CBDCs being looked at. And I know the MAS has an ongoing project in Singapore. So maybe, Chu, if you could talk a little bit about that.
Sure. I think for that, they're probably interrelated questions, but when we talk about central bank digital currencies, CBDCs, I think the one major split that it is important to think about is wholesale CBDCs, which are primarily intended to be used among financial institutions, and retail CBDCs. And usually when people think about CBDCs and think about both the pros and cons, they're generally thinking about retail CBDCs, where your man in the street, you and I, would hold these CBDCs and use them to buy coffee. The MAS has been for many years now experimenting and researching CBDCs. Much of that focus has been in the wholesale space. So an increase in the ability for the use of CBDCs for interbank settlement rather than retail use, because Singapore is a very small island with a pretty advanced fiat electronic payment systems. The view was taken pretty early that it was unlikely that a retail CBDC would provide very much in the way of improvements from a retail standpoint. So going back to your question about, therefore, these tokens affecting traditional banking, I don't think that's a concern that the MAS has in Singapore, with it being limited to a wholesale CBDC.
Great. Yeah, thank you. So I want to sort of shift the conversation a little bit. We've been focusing in the beginning parts on, looking at centralized entities and the regulations and laws that apply and some of the issues that have come up recently. And I think, some of these failures sort of highlight this distinction between centralization and decentralization. And so a high level question is, what does decentralization mean, and how does it come up sort of in your practices and in the legal standards in your jurisdictions? Melissa, I know that in Cayman, Cayman foundations have been an important part of the decentralization process. So can you talk a little bit about that?
Yeah, definitely. So decentralization. So for us is we work a lot on setting up Cayman foundations to act as legal wrappers to DAOs. And I think the move is, giving the DAOs the voice, right? Giving the holders of the voting tokens, the governance tokens, the ability to vote on the direction of a project or to approve grants for a relevant ecosystem. So it's all about us bringing together a community of, persons with the same purpose, that is to advance that protocol. So a lot of times we have, I read that there's about 7,000 DAOs in the world now, many of them without legal entities to represent them. So they.
Can we just set the stage? And when you say DAO, what do you mean?
Oh, sorry. I mean decentralized autonomous organization, which comprises of a community of persons that may have the same purpose on how to advance a particular project. So they would have the ability to vote on a project. So typically they would hold what we call a governance token or a voting token, which will allow them to submit proposals and discuss the relevant project on a discourse channel, and submit a proposal to advance that ecosystem on, let's say, a protocol like Snapshot, where the community will then be able to vote on that proposal. So the aim is to advance the ecosystem, whether it is the ape coin, make a DAO. So we have a lot of these DAOs in existence that really operate to further a particular ecosystem, and MakerDAO was one of the very first ones that we actually worked on. So we set up a Cayman foundation for MakerDAO, and MakerDAO then voted on, what collateral can be held, what is the size of the collateral that should be deposited for that DeFi protocol. So you might be asking, why are we imposing these legal entities for DAOs? A lot of times it's because you still need an entity to engage in real world transactions. It's well and good to say, hey, we're going to be voting on chain and everything can be done on chain. Unfortunately, not quite there yet. We still need to have an entity that can enter into services agreements, consulting agreements. We might even need a legal entity to have bank accounts, because sometimes you just need to pay for that festival, that sponsorship in fiat. And then more importantly, the number one consideration now from many of our clients is limited liability, because the Cayman Foundation company is a company and it creates that shield of limited liability for the token holders, so that if there's any actions against the DAO, then we would hope then that the action or claim will be against the foundation rather than each individual member of the community. That is, each individual member that holds tokens, that votes in that DAO.
Yeah, thank you very much, Melissa. That's very helpful. And then Ben, I wanted to turn it over to you. How do you see the concept of decentralization playing into the litigation context and some of the work you're doing?
Sure. And just to build off Melissa's point first, because I think it's important to understand the interplay between DAOs, the community itself, and aggregating interests and working together in these decentralized market platforms, but also DeFi, right? When we're talking about decentralized finance, because sometimes they're kind of overlaid and we see them both cropping up together. So just to be clear, in this instance, we're talking about DAOs, those communities working together in these decentralized finance markets where you get this peer-to-peer financial services being offered, like loans or things like that, on public blockchains. And you're cutting out the institutional middleman, getting rid of the fat cat that's in the way, and having these instantaneous, sort of in the same moment, happening and not happening, depending on the outcome, financial transactions, which obviously there's a lot of purists out there which can geek out about that and love the concepts. And we've seen DAOs do some amazing things when they aggregate that power together. So that's on one hand very interesting to see it happening and seeing the power of that. But on the other side, we've seen extensive billions of dollars of fraud with DAOs and with DeFi platforms. And it's interesting because we start talking about, well, how does it happen and who's responsible? And that usually is when people call me, because you've got these massive transactions going on. You have a lot of anonymity, obviously, on them. And there's a lot of excitement and purist about having that kind of purchasing power. But then you sometimes have DAOs that aren't even a thing, right? They're not necessarily LLCs. Some are, some aren't. Some aren't incorporated because I think there was belief among their principals that they somehow wouldn't get liability. I'm not liable for really bad code and smart contracts in the platform if I'm not, a corporation, if I'm not formalized. So we've seen that being challenged in many respects. But then the other interesting side of it is, and again, this is from more the litigation perspective, and we've seen it with a few instances, and Mango Markets is a great example where $116 million gets drained because of bad code, and then the people who might have contributed to the bad code, the principals, come up with a settlement and a vote for the DAO on a settlement saying, well, why don't we let the bad actor who says he didn't do anything wrong, it's arbitrage, it's a commercial transaction, why don't we let him take a whole bunch of it as a bounty, and then we'll agree not to sue him, not to freeze his assets, not to get law enforcement involved, none of which you can't do that, of course, but they agreed to it anyway. And now what do we have? The Securities Commission's coming after them. You've got lawsuits coming after them. Eisenberg gets arrested in Puerto Rico because of it, and there's a criminal matter. So I think it's interesting because who gets that responsibility? Who bears that? Does a DAO vote mean you've lost your civil rights to go after them? And I think we're going to see a lot of those answers in the Mango Markets case pretty soon in New York.
Yeah, super interesting. And I think the question of where do you draw the line in terms of responsibility is sort of the big one. I wanted to talk a little bit about CFTC enforcement action involving OkiDAO and see if you guys had some thoughts there. I do think it's important to just highlight something that Ben said, which is, DAOs can be set up to run lots of different types of protocols. And so you can have a group of people that come together with a common purpose and sort of contribute their time and effort to building lots of different things. The Mango Markets protocol was a DeFi protocol. The OkiDAO protocol was also a protocol that allowed participants to engage in financial transactions that would otherwise be highly regulated if there were, if that platform was put out by a centralized entity, and that's what the CFTC case is about. So I think there is a distinction between a DAO coming together to provide what would otherwise be a regulated financial service in the US or in Canada or in any jurisdiction, and a DAO coming together to provide some other type of a service or develop some other type of platform. But I guess the question about line drawing is when you have a loosely affiliated group of people, how do you apportion responsibility? And in the OkiDAO case, the CFTC wound up bringing an action against an unincorporated association. So I don't believe there was a legal wrapper associated with the DAO. Melissa or Drew, do you have thoughts about that?
Yes, that's right. After that CFTC action, we did receive a lot of calls from US lawyers and US clients about then putting in place a Cayman Foundation to be that legal shield, that legal wrapper for DAOs that do not have legal entities. When we're talking about existing DAOs here, not newly created DAOs, because they were very worried that the same thing will occur to them, that each holder of a voting token in the particular DAO will then be subject to any action by the CFTC in their personal capacity. I can't speak to US law, but perhaps the view was that they could even be seen as general partnerships, as in each member of the DAO is seen as a partner to each other. So we've been very busy setting up these Cayman foundations to put in that shield, and hopefully then if there is going to be another claim in the future, that would be against the foundation and not the DAO members. But we will have to see.
Thanks very much. Chu, do you have thoughts on this?
Largely, I would echo what Melissa has said. The other thing that not having an entity creates is this vast amount of uncertainty about who is a member of the DAO, specifically if an action is taken. Given how quickly these governance tokens trade, if you've ever had the Oki token, does that make you but if you don't have them now, or if you didn't have them when the CFTC brought forth its action, did that make you a member of the DAO? So I think that there's a vast amount of uncertainty there, which I think is where I think the interposing a layer of the Cayman Foundation has been enormously helpful.
Yeah, and just on that point, while individual holders of the Oki DAO governance token were not named as defendants, the remedies request from the CFTC certainly asked that token holders who participated in governance votes, be prohibited from engaging in certain activities involving commodity derivatives for 10 years. So there could be significant consequences, and the CFTC chose to sort of draw the line, at least for the purposes of the complaint, at token holders who actively voted on governance. And whether a judge will go along with that or how that plays out as the case unfolds is another question. But at least we have a sense of where the regulator stood there. Ben, do you have thoughts?
Yeah, I just think it's an interesting comparison, because you've got the Oki DAO case where you don't have that LLC or that entity, and then you've got Mango Markets where you do, and you see differing directions in where they go. And I think very interesting questions on both sides as to the implications on who crafts the governance vote, right? Did other people have input into that governance vote? Who voted on who didn't? What was quorum for that vote? I mean, even with Mango Markets, the person who stole the tokens, he voted, right? And he had a lot of tokens to vote too. So there are some perverse results in what is a very noble and purist approach in these DAOs. But when you do put them on a protocol like DeFi, like you said, Greg, it creates some very interesting questions about what's an agreement, what is consent. And I think we have to interface these old concepts of what that means in our courts with these new instruments and how they're actually executed upon. So I think they're both going to be an interesting test case when you don't have the LLC, and one where you do, and where the courts find that consent and agreement.
Yeah, no, I think that's a great question, or a great point. And I wanted to just follow up on that because, a lot of these protocols are, just smart contracts deployed to a blockchain, and people can choose to interact with them if they want to or not. Typically, there's not sort of a legal agreement that gets entered into by participants and the protocol. So, for instance, if I went on the Mango Markets and I wanted to engage in a transaction, just from a litigation perspective, do you think that there would be a legally enforceable obligation against the protocol or against the DAO with respect to my interaction with the protocol?
Well, if you come
on the traditional side, you would have some sort of an agreement where, like, the terms of the transaction would be set forth. I would read it or not, but I would sign it, and that would be my binding signature. If I had a problem down the road, I would look at the agreement, and then I'd carry the agreement into court, and I'd say, Judge, they were supposed to do X, Y, and Z. They didn't, and I suffered a loss. That's not exactly how it would work with a DeFi protocol. So just curious as to your perspectives there.
Yeah, I mean, just quickly myself before I pass it back, I think it depends if you ask the purists or not, right? Because some people say it did exactly what it was supposed to do, right? The smart contract and the code did what it was intended to do. And if you're participating on that, you should have a sufficient knowledge base and comfort level that you were able to read what that transaction, the code was to do. Now, that's extremely complicated. And obviously, they're still finding errors in some of these recycled smart contracts. So perhaps that's putting too much of an onus on a user and a trader. But I think some purists would say, you know, you got what you paid for. It just wasn't what you thought it was. I think the courts, though, you know, we'll see, but I think they're going to take more of a logical and more reasonable approach to it and saying, you know, well, could that have really been what that user or trader intended, right? That result. And there's some perverse examples like Mango Markets. How could you have intended that someone would rebalance the value of tokens, take all of them and leave you with nothing? That's hard to explain that, you know, in reasonable, rational terms, that was what you intended when you participated on this. But then it becomes a question is who's responsible for that? Is that just buyer beware, or the principals who were contributing to that code, or the originators of the code, are they really bearing that responsibility? Because it's not what they really offered out that a reasonable person would have thought it was going to do.
Yeah, no, that's super interesting. I wish we had a little bit more time. I think we're running sort of up on the end of our time here. I wanted to give each of the panelists just a quick opportunity to share some last thoughts. So Melissa, maybe we can start with you.
Yeah, definitely. So we've talked about bankruptcies, centralization, decentralization. I would say that given that, you know, the high profile bankruptcies, collapses have involved centralized entities, I would expect that decentralization will continue to be the trend.
Thanks. Chu, I see some nodding, so.
I think I would completely agree. I think that, you know, when the collapses first began, I think the narrative was you know, largely that, you know, crypto is going down, and these are problems that have to do with crypto. As things continue, I think people are like examining it a little closer and identifying, exactly as Melissa has mentioned, that the crypto groups that collapsed were all these centralized entities and not the decentralized protocols. So, you know, it's important to bear in mind that decentralization isn't perfect either, as Ben mentioned. It you know, it has its own a different set of risks and challenges. And so I think as we'll see the wiser regulators regulate both differently.
Yeah, thank you very much. Ben, any last thoughts?
Just agree. Decentralization is going to be, I think, a lot where the attention is going to be, and it's going to be really fascinating to see how much incorporation and traditional concepts we see built in for protections, or if the Wild West is going to continue.
All right. Well, I want to thank everybody for joining. This was a great panel. Thank you to the panelists, and thanks again to Chambers for giving us the opportunity to talk blockchain. Much appreciated.
Fantastic. Thank you, Greg, Melissa, Ben, and Hugh. That was a fantastic session full of fascinating insight. We're now connecting our final panel of speakers, and the panel will be cyber attacks, threat response, regulation, disruption, and international coordination. Our moderator is Alan Rawle at Sidley Austin, and he's joined by Jim Halpert, General Counsel, Office of the National Cyber Director, Executive Office of the President, and Brian Vaughan, Assistant Director of Cyber Division of the FBI. So I can see that our panelists are appearing. Welcome, Alan. Delighted to have you with us. I'll now hand over to you.
Thank you, Claire. And I needed to adjust my lighting there so I didn't appear as blue as I started out, but I think it looks fine now, and appreciate the opportunity to moderate this very timely session on cybersecurity. And I'm pleased to be joined by two of the most outstanding and relevant speakers that our audience could hear from on cybersecurity from Washington, D.C. My name, again, Claire's, as you indicated, Alan Rawle. I'm the founder of and partner in the global privacy and cybersecurity practice of Sidley Austin, and I'm based in Washington, D.C. and New York City. I'll introduce our two speakers and then turn it over to them to address some very timely developments that I know the audience will be very interested in. So Jim Halpert is the General Counsel of the Office of the National Cyber Director in the White House. Jim is a renowned cybersecurity and privacy lawyer, and I will say that I'm personally very honored to moderate a panel with Jim, as he's one of the leading legal luminaries in our field of privacy and cybersecurity. Jim joined the Office of the National Cyber Director, known as the ONCD, from the law firm of DLA Piper. He built the firm's cybersecurity practice and has advised dozens of clients and has handled over 700 security incidents. He's also helped draft almost all of the state privacy, cybersecurity, and data breach notice laws, as well as been involved in the drafting of federal privacy laws, some of which may come to fruition perhaps before terribly long. Jim's an honors graduate of Yale College, Harvard Law School, and the École des Hautes Études en Sciences Sociales. Our other panelist today is Brian Vorndren, who's the Assistant Director of the Federal Bureau of Investigation's Cyber Division. Brian was named Assistant Director of the FBI Cyber Division in March 2021, and recently also had served as Special Agent in charge of the New Orleans office. In addition to other positions, in 2013, Brian was named to lead the Washington Field Office Joint Terrorism Task Force, and has also served as Deputy Assistant Director of the Criminal Investigative Division in 2018. I'll also note that Brian was featured in the Wall Street Journal less than a month ago with a very flattering photograph, and also with a headline that the FBI Director Christopher Wray wants business to help fight China cyber threats. And Brian is quoted in the article as promising to provide at the FBI a Ritz-Carlton level of customer service in an effort to encourage companies to report incidents to and work with the FBI in connection with their incidents. So I'll first turn to Brian Vorndren from the FBI and ask him, Brian, would you give us a bit of an overview of the threats that the country, the world is facing? The article I cited from the Wall Street Journal indicated China was a principal adversary. What's changing? What's staying the same? And have we? What are the trends in the threats? Are we making some progress? Are things getting worse, getting better, or pretty much staying neutral?
Good morning, good afternoon, everyone. Can I just get a thumbs up that I have good audio? Okay, great. Thanks for the invitation today. And Alan, to answer your question directly, within the nation state space, the four significant players remain the same, with China, Russia, Iran, and North Korea. And we really see the threats presenting themselves in three different ways. The first is theft of PII, or intellectual property, which I don't think surprises anyone. The second is exfiltration of data and dumping it on the internet, or the creation of disinformation about an organization and putting it on the internet. And one question we always ask organizations is, not only how long would it take you to identify exfiltration and leak, but how long would it take you to identify disinformation which is out there about an organization, how that could affect a company's valuation? And then the third piece is, the third vector is really access and furtherance of attacks. And when we talk about this, if we have folks in the military refer to this as prepping the battlefield, but is how do you get a foothold of persistence and then for further kinetic action at a time to be determined. When it comes to nation state activity, we do think that detection, containment, and eviction is the primary goal. Prevention is likely not a realistic goal against an adversary, especially like China, who is actively identifying and executing against multiple 0 days. Within the criminal space, ransomware as a service remains the top threat, although we have seen proxy botnet services start to trend upwards, meaning unwitting botnet nodes being used for malicious activity, whether that's child pornography or other activity. But sticking with the ransomware as a service element, very, very entrepreneurial group of criminals who really have lowered the barriers to entry, and they've done that by consolidating the expertise in malware development and then allowing affiliates to essentially leverage the malware code to stand up independent infrastructure for short times and execute attacks. the malware developers are really cordoned off from the affiliates, but they essentially get royalties of 20% or 25% of each ransom that's paid. So they are insulated, and obviously the safe haven nature of the problem poses a significant challenge for all of us in the government space. The only other thing I would say about this is it getting better? Is it not getting better? Really hard question to answer. We believe that our best data, and when I say we, I mean the US government, not the FBI, that our best data only has about 25% of the total intrusions that actually occur in the United States. So it's really difficult to say whether the problem set is or is not getting better. With that said, I would say that we have seen a small trend away from extortion and, data exfiltration and then encryption events for ransomware to the criminals just focusing on data extortion. That's probably for two reasons. The first is that resiliency and net defense are likely improving, and that the criminals have realized that companies or organizations will eventually recover from an encryption event. But the data exfiltration piece and the extortion value of that is of tremendous value to an organization. And just one last note, as I said on nation states, the goal is detect, contain, evict. It truly is a game of cat and mouse. We believe with ransomware and general criminal activity, the goal should be prevention. And there's a significant reason behind why we feel that way. But Alan, I'll hold my comments for the rest of the time here, but appreciate the first question.
Thanks. And are you seeing in response to, are you seeing companies that are taking up the Director Ray's interest in getting reports of cyber incidents? You mentioned only 25%. Is the outreach that you're doing prompting additional reports, or are you hopeful that it will?
I was certainly hopeful that it will. It's very difficult to say whether it has or has not, again, just based on the ebbs and flow of the data stream that we do see. I do believe that the audience here today is the most instrumental audience in encouraging sharing and reporting. Undoubtedly, clients take their advice from this group of folks, and that's obviously an important relationship for us as well.
Thanks for that, Brian. Can you tell us about the legal authorities that are relevant to the and that the FBI relies on for your work in the cyber field? And as I understand it, the FBI is a kind of a victim-centered organization, and again, you're working kind of to help protect the victims and the companies involved. What are the legal authorities that you rely on?
Sure, it's an excellent question. And, I'll just take a top-down approach on this. Obviously, our title is what it is, which is Federal Bureau of Investigation. And that investigation piece is obviously at the core of our DNA. But I do remind people routinely that at 115 years old, we've also been victim-centered for the entirety of that decade plus of time, whether that's violent crime, whether that's abduction of children, or whether that's cyber. The center of our organization starts with being victim-oriented. In terms of statutory authorities, I'll just highlight a few. First, within U.S. Code, obviously Title 18 governs all of our investigative activity, and those are the statutes that we use to charge. But I think of interest is that everything we do, whether that's helping victims, whether that is doing on-network operations to degrade the ecosystem, whether that's sharing with domestic or international partners, whether public or private sector partners, is derived from our investigative activity and generates the intelligence and the tactical information that we can share. A couple other keynotes. Within Title 18, there's a subsection under Section 1030 D2, which indicates that if there is a nation state attack against certainly US equities where IP is being sought to be stolen, then FBI would have lead in that investigation. The FBI is the lead domestic counterintelligence agency in the United States. Obviously, post 9/11, we have very specific mandates in the U.S. Executive Order 12333 and Title 50 that essentially say the FBI is mandated to inform the American public and domestic partners about the nature of the threats that the United States is facing. And we take that very, very seriously. But again, that work is really derivative of our investigative capacity. And the last two or three I'd highlight are this, Rule 41 within criminal code really dictates search and seizure. That is becoming more and more important in our world. When we look at the removal of Hafnium's malware off of US infrastructure about 2 years ago, when we look at removing GRU's malware off of the WatchGuard routers last April, just after the invasion of Ukraine, that is done under Rule 41 search and seizure. And the critical part of the Rule 41 basically says the FBI, through a criminal affidavit before an independent magistrate judge, has the ability and the right to seize instrumentalities of a crime. And we would certainly argue, and I think correctly argue, that malware installed covertly on US infrastructure by the Chinese, Russians, or anyone else is instrumentalities of a crime, and it allows us to seize that malware and break the communications back. And then just a brief touch on FISA. Obviously, we have FISA Title I, Title III, which is traditional search and surveillance of electronic devices primarily here in the United States, and then FISA 702, which is well reported on, which is our ability to collect on foreign actors and foreign adversaries.
Yeah, thanks for that, Brian. And just to elaborate a little on the citations there, FISA is the Foreign Intelligence Surveillance Act. Title 18 is the criminal section of the U.S. Code, and Rule 41 is search warrants, essentially. You mentioned working with other agencies, Brian. Could you, if you have an incident or you're investigating an incident, how does the FBI, who do you work with in the government? And I know that there's interest too, and this was addressed in the Wall Street Journal article. There are the other cyber agencies and intelligence community agencies you work with, and then there are the regulators, and you work with some of them, and tell us about whether you do or don't work with the others, and how that interplay occurs.
So, Alan, if it's okay, I'll just try to walk everyone through what this looks like on the ground when there's an intrusion and when a organization decides it wants to engage the FBI in any number of different ways. So, broadly, our response should look like this. Maybe let me say this, it should not look like this. 6 people showing up in a black Suburban with FBI jackets on, right? That is not how we quote unquote respond. This usually is a series of orchestrated phone calls with outside counsel or inside counsel and the designated personnel from the victimized organization. And what we really encourage over and over and over again, and this goes to something Alan said about the Wall Street Journal article, is our initial priorities are the victim's initial priorities. And so we have been asked to, for example, direct all national and international media inquiries to the FBI on behalf of a victimized organization, so the organization can just focus on their work, right? We've been very close to deploying victim service specialists to help people who weren't going to get paychecks, right? The list goes on and on. Certainly, we have been asked to remove servers from being online to protect the forensic evidence on them for the benefit of an organization and for our benefit as well. But really, I would put the odds at 3/4, 1/4. The three quarters of the asks are soft asks, right? Not, really cyber or forensic asks. And really what we try to emphasize, it is the soft skills, it is the human element that really leaves a lasting impression. And when we focus on the soft skills, the human element, what we find is that we build a relationship for really a lifetime. So, there are some very key pieces of intelligence that are helpful to us early. And these will not surprise you, right? Obviously, logs, specific, what I say, attacking IPs, but IPs where the vector of the attack originated from. If there is a ransom payment in question, any information on the virtual wallet. And then if forensics indicate data exfiltration, if there is a cloud account in play where the data was pushed through or pulled through by the adversary, those are very, very important pieces of intelligence for us. And from a timeliness perspective, the most two relevant timely pieces of intelligence are the virtual wallet, and if there is a cloud account in play for data exfiltration. Admittedly, the logs, the IPs, those can come to us a week, 10 days later, and we're going to be able to do the same amount of good with them as we would 24 or 48 hours afterwards. But then going into the question about cooperation, the reality is that we work with NSA, CIA, Cyber Command, Treasury, CISA, very transparently. The relationships with them are very much common purpose focused. I can assure you that if we have an opportunity that is relevant to NSA from a victim and we call, the answer is not, we'll get to you tomorrow. The answer is, okay, let us know how we can help. And we really do focus the interagency around that term, common purpose, common sense of mission. And there is a tremendous willingness to try to help private industry or academia, et cetera. But we only engage them when there is direct return on investment, either for the US government or for the victimized organization. There's really no value in sharing everything in real time with all interagency partners. We really nuance it out a little bit better than that to be efficient. So Alan, hopefully that helps offer some perspective.
Yeah, absolutely. Briefly, Brian, before we turn to Jim for his very timely and topical developments that are coming out of the White House, the FBI and working with the Department of Justice, you've had some successful disruption events with Cyclops Blink, which you alluded to, and Hive, the Hive ransomware. If you could just describe that a little briefly about both of those disruption successful initiatives, that would be great. And then we'll turn to Jim, talk about the White House National Cybersecurity Strategy.
Sure. Some of my favorite topics. I think that within the Bureau and within the cyber program, we've really started to emphasize degradation of the ecosystem, right, through an all tools approach. And so what we say at a strategic level is our job is to work with our domestic and international public and private sector partners to develop a campaign against an adversary to degrade their capability to leverage cost on us, right? And if that means that NSA is in lead, that's fine. If that means our counterparts in the UK are in the lead, that's fine. It's really an all tools who's best positioned degradation to impose maximum impact and cost. So within that is a subset of really broad computer network operation, computer network exploitation work. And, certainly from my perspective, there is a need for the FBI to step more aggressively into that space more routinely. This type of work is easy to talk about. It is extremely expensive and difficult to do. And so we do have limits because of those two variables. But, the examples that Alan referenced with Cyclops Blink, but then also with Hive, are examples of us trying to bring pain to the adversary on their networks, right? So with Cyclops Blink, it was specifically a combination of work between international partners. I'm going to stay vague there because I don't know if I'm clear to share who, and the FBI and a very specific company in the United States. And the combination of those three partners together, we're able to see the Russia's GRU building a global botnet in the lead up to the invasion of Ukraine. And it was through that cooperation and specific code that we wrote that we were able to go into the compromised devices and essentially destroy the malware and remediate the vulnerability. With Hive, just super proud of our team, and super proud of private sector partnerships that we had that enabled that, but we essentially owned Hive's infrastructure for 7 months. And so we were able to provide about $130 million in relief through decryption keys to victims while we continued to map out and then eventually take ownership of Hive's infrastructure. And I think just a final note, we talk a lot about all being in the game together. And when we are able to work across forensics firms, ransomware negotiation firms, the legal community, the FBI, and more broadly, the US government, and keep quiet for 7 months that we can decrypt anyone who has been hit by Hive, I think that's a credit to all of us about how important we see bringing relief to victims. So thanks, Alan.
Yeah, and just as a having had the privilege and of working with you and your colleagues on the Cyclops Blink matter, as you know, Brian, I can certainly attest for the audience that working with the FBI and the Department of Justice can be very effective, not only for the government's interest in disrupting, dismantling these threat actors, but also the work that the FBI and Department of Justice do with the companies is in fact a partnership, a public-private partnership collaborating really towards the same ends of defending the country's interests and the company's interests and the company's customers as well. So thanks to you, Brian, and the FBI as well. Jim, I see he's off screen right now. Why don't we give him a moment to come back here? When he returns, we'll turn to the White House regarding the national cybersecurity strategy. While we're waiting for Jim, Brian, one of the points that we didn't get to earlier was in ransomware events, where I know that the government and the FBI in particular does not recommend paying ransom, but it's understood that there are circumstances in which it may be exigent. But the Office of Foreign Assets Control at the Department of Treasury, which you referenced, has really pointed companies thinking of making payments to work with the FBI. Is that something that you recommend as well, and that you find that companies do come and consult and coordinate with the FBI on ransomware?
Yeah, I appreciate the reminder about this, Alan. So let me just really quickly answer about regulators, and then I'll answer about OFAC. We do get asked quite routinely about what the FBI's relationship is with regulators. And when I say we don't have one, that doesn't mean we don't interact with them. Of course, we interact with them, but we will never share our information with them, whether that's derivative of our own investigative activity or information that's shared by a victimized organization. We do say that the relationship between a regulator and the regulatee is between those two. We're really not a proxy for that. On OFAC, just briefly, the guidance from OFAC is just that, early engagement with law enforcement. And so we are always available to help to the best of our ability to determine whether an organization is engaged with a sanctioned entity. Just one other note, we have seen a trend that victimized organizations actually don't want to know if they're engaged with a sanctioned entity. And I think that's posing us some ethical and moral dilemmas within conversation. But to your core question, Alan, of course, anyone that wants to talk to us and we receive these requests routinely, we're more than happy to do what we can to help determine if you're engaged with a sanctioned entity.
Great. Thank you, Brian. And I think Jim, you may have had some technical difficulties in his audio. Are you? Can we hear you?
Can you hear me, Alan?
Yes, now we can hear you, Jim. Great. Well, glad that may be resolved. I hope it stays resolved for the sake of our audience. And
it should be. So sorry.
It's breaking up a little bit. Let me try a first question and we'll see if it works. So, Jim, would you tell us about the cybersecurity policy structure and execution structure that you at ONCD, Office of the National Cyber Director, how it fits with the National Security Council, CISA, the Cybersecurity and Infrastructure Security Agency, and others? Just give us a quick lay of the land, and then I know everybody's interested in the new strategy, so we'll turn to that quickly.
But first of all, ONCD was created by Congress in 2021 to coordinate across government a well-staffed White House oversight function to make sure that we are driving coherence in the U.S. national cyber mission, working closely with the NSC, which is more thinly staffed. And the way that we're dividing the waterfront, informally, there's some exceptions, is that ONCD does implementation work because we're staffed to do that. We have 82 people sitting in the EOP, and Pound Cyber has a much smaller team. Pound Cyber will deal more with the day-to-day crises and has been driving an effort to improve cybersecurity across standards across government in the EO 14028, as well as all the offensive work, and also has been a very strong voice for filling gaps in cyber regulatory authorities in a way that's smart and forward-looking. This is the quarterback, as we like to say, we're the coach, they're the quarterback on the field, helping lots of agencies with their own cybersecurity and interacting extensively with the private sector, including providing the Einstein solution to monitor networks, lots and lots of collaboration. CISA is a very large agency and has capacities across many offices. The FBI has even more, and the FBI is a central player in this effort, as is the NSA, for example. So this is very much a team effort trying to leverage as best we can strengths across the U.S. government.
Thanks for that, Jim. That's an impressive whole of government array that you're describing. A lot of that, of course, is addressed and is the foundation for the National Cybersecurity Strategy, which we appreciate you and the President issuing just before this Chambers and Partners video conference, because we've been waiting for that. It has 5 pillars, and we're looking forward to hearing from you what the National Cybersecurity Strategy is all about and how it's how it works with the executive orders. You mentioned Executive Order 14028 on improving the nation's cybersecurity that President Biden issued about a year or so ago. Tell us how this new strategy, what's in it, how is it supposed to work, and how is it going to get implemented?
Sure, but the strategies are major efforts. They don't turn on a dime in terms of realizing vision, but it is really a commitment to significantly improve our national cyber defensive structure. EO 14028 was a great and important step in shoring up federal cybersecurity with a nudge on IoT security, and shortly we will see some new contracting requirements that reflect for government contractors cybersecurity implications for government. There are a host, and I can circulate a slide with highlights. There are things like a Security Safety Review Board, which is jointly co-chaired by the government and private sector, to convene following significant cyber incidents to really derive lessons learned in light of what happened and make recommendations. There's also a standardized playbook and set of definitions for incident response, significant upgrades to federal cybersecurity. But this largely deals with the U.S. government and is largely internally focused, with a few exceptions that I just mentioned. And the cyber strategy, which is required by law, probably by our authorizing statute, is usually adopted every 4 to 5 years to move the direction forward beyond where we are right now. And previous strategies have really focused, I think rightly as initial steps, and a number of them have been really good, on a foundation of information sharing and public-private collaboration. This strategy builds on these essential building blocks, seeking to improve those functions further, to push for a vision of unprecedented federal government collaboration with civil society, private industry, and international allies and partners. A lot of this is happening informally. This formalizes and aims higher. There was a lot of consultation with all of those constituencies in developing the strategy, and we're hopeful that this will meet significant support so that as a nation we can move forward in a growing strategic convergence across both sectors and nations.
Jim, you mentioned.
Should we go?
Yeah, let me just add,
Sure,
we'll go to that next thought in a moment, but you mentioned that there might be new contracting requirements. Are those, is there likely to be some addition to the federal acquisition regulations is that how it's going to evolve?
Yeah, this is the last major to-do in 14028, and the federal acquisition regulation needs to align with some of the requirements in the EO. So we're likely to see that in the coming weeks, months. And but that is probably the most direct touch on the private sector in EO 14028. And what we're trying to do here is to rebalance, I would say, the responsibility to defend cyberspace, recognizing that there's a significant portion of that the FBI and other parts of the federal government do already and can do more of, but also recognizing that in today's digital ecosystem, digital cyber risk too often devolves downward onto small businesses, local governments, even mid-sized businesses, as well as individuals at their computers. And these are really the entities with the least capability and resources to be the first and last lines of defense. And so we really want to make sure that, and you can look at the Colonial Pipeline, for example, incident, where one person's mistake in clicking on a phishing email resulted in a major incident. And we need to move so that there's greater security and resilience built into the system. The best positioned and most capable actors in the public and private sectors can and should assume a much greater share of the burden for mitigating cyber risk. We can't be reactive all the time. And at the same time, there should be unparalleled collaboration between the federal government and private sectors to re-architect certain vulnerabilities so that they're rarer and rarer. Finally, we should shift incentives so that when entities across the public and private sector are faced with trade-offs between temporary fixes and durable long-term solutions, they have the resources, capabilities, and incentives to consistently choose the latter so that the overall ecosystem isn't being patched over and over and over again. Some of that is inevitable, but we can build in better incentives so that when entities on this call, their organizations purchase software or hardware, they have greater assurances of protection.
In the cyber strategy, I think what you're addressing with regard to purchasing tech products and software and the effort, the policy initiative to shift liability to the developers of software for vulnerabilities and tech products. Is this and there's also a reference in the strategy to with regard to disclaiming the end user license agreements typically disclaim liability for any vulnerabilities in code. It's sort of as is. How is that going to be effectuated, that policy initiative?
This is a long-term issue. We decided to put this into the strategy to provoke prompt a long-term discussion about how we make the common building blocks across even critical infrastructure be incentivized. Right now, the incentives are to bring product to market fast with new features and at a competitive price point. Nowhere is there an incentive, particularly if you can disclaim liability for security incidents, to do more than patch. Yes, there's some reputational risk, but right now it's just too easy when you have sophisticated actors often with market power negotiating to have security be sort of an afterthought for that the purchaser or licensor needs to take care of. And there will be, I think, ongoing discussions about this. We don't see this as a 2-year or a 4-year fix, but we think that it's critically important if we're to move to a more secure future.
Thanks for that perspective. Very, very helpful. Kind of starting the conversation, but it'll take some time to propagate. Harmonization. One of the realities that companies subject to cybersecurity risks, which is every company, is that many of them, especially in regulated fields, face a plethora of cybersecurity standards and obligations and regimes, legal regimes. One of the points in the strategy is about an effort to promote harmonization. That seems, from the private sector, seems a pretty important mandate. How will that play out, that effort to promote harmonization?
Well, this is something that is extremely important to ONCD. We get it. We understand that regulation for regulation's sake is not a solution, and we can't even regulate ourselves into security, hence the software idea about having some sort of safe harbor that companies or publishers could be. But in regulation, we are looking at working across the interagency and are already in discussions with the Cyber Regulators Forum or independent regulators to begin to chart this path. This is something that the business community is very welcome to work with us on. It's going to be important to figure out a structure, and we're open to lots of suggestions, where there is a baseline that fills gaps that have not yet been filled, for example, in the water sector, that are critical infrastructure. So by creating a single approach for minimum standards that would apply across critical infrastructure, we would both raise standards, update them, make them more risk-based, which is what everybody says they want, I think does want, and at the same time give some additional authority to regulators to focus on risk specific to their sector. So the Nuclear Regulatory Commission would be able to keep elements of NERC SIP that are important for nuclear safety. We would also, for example, the FDA has unique cyber equities. But by doing this and also creating some degree of reciprocity or most favored nation status with respect to compliance with the same baseline, we would have a structure that would allow regulators to focus on the things they know best, particularly the independent regulators. What are the specific things in their sector that are not overall nearly as technical, they're more outcome-based? And we think that that approach would greatly lower the cost of compliance for the baseline, and it would make crosswalks between regulatory structures much easier. Each agency would put out what their additional requirements were. And I think that is very, very promising for the private sector to reduce costs, to make sure that cyber regulations are focused on, in a risk-based way, on real risks and drive risk management. And at the same time, it will produce better outcomes than a huge variety of different regulations based on particular authorities. But that ultimately requires Congress to act. And it requires, I think, the business community that I think wants this to step up with civil society that also sees the benefits of this and to make the case. Speaking to the Chamber's audience, we also would like to see this baseline harmonized across allied countries as well, to have a common set similar to ISO or NIST that would evolve over time, but would be internationally interoperable among friendly nations. So if there's support for this in the US, we would be absolutely delighted to help drive this internationally. But we need the help of everybody on this call who are affiliated with organizations to say this is a good idea. It would have to be flexible also as new threats come along, but changes would be uniform. So you would not have weirdnesses in different approaches. Brian, your video is on. I don't know if you have thoughts on this, but would welcome them.
Yeah, maybe. Thank you, Jim. That was a great overview of the strategy and the cybersecurity from the White House perspective, which is obviously salient. So I think we've just about reached the end of time. So Brian, any closing thoughts from your perspective?
Simply a closing thought about partnerships and best practices, right? I mean, we say on our side, and I know Jim would agree, that cyber is the ultimate team sport. And it's going to take all of us coming together, whether that's secure coding practices, whether that's pressuring the threats that are facing us, to bring everything we have to bear domestically, internationally, private, public, to make sure that we impose costs in advance. So just an emphasis on partnerships and a trust and hope that you find the FBI a very good partner as well.
Thank you, Brian. Thank you, Jim. Thanks to the audience. I know I speak on behalf of the audience and Chambers and Partners in thanking the General Counsel, the White House Office of the National Cyber Director, Brian Bordrin, the Assistant Director for Cyber at the Federal Bureau of Investigation, for fabulous comments today. And with that, appreciate the audience attention here, and I'll turn it back over to Claire Oxborough at Chambers. And thank you, Jim. Thank you, Brian.
Thank you. Thank you, Alan. Thanks, Jim. Thanks, Brian. It's been a fantastic session. I'm delighted that you could join us today. The whole event has been full of invaluable insight and analysis. So I think we've really had a great afternoon. Thank you to all of our wonderful speakers and to the audience for joining us today. Thank you, everyone, for joining us today, both audience and speakers.